All right, peeps, how you doing? Time to get on with it. Hello, hello, hello. Oh, yeah. How's your mum? Welcome to FOMC Live, baby, where the Fed's gonna come out and do nothing today. Yeah, how exciting is that? So at 2 o'clock, we'll get the nothing. But inside of that nothing, we are going to get the summary of economic projections. Very cool. And we're going to look inside the brains of these FOMC members because they tell us they're unanimous in their decision-making process. Okay, well, that sounds very good. But then you look at the summary of economic projections and then specifically the dot plots, and they don't agree at all. Not even a little bit. So we are going to get this SEP and learn the truth about what the Fed thinks. Okay, so that is our goal. And then at 2:30, we will get the press conference. And that's cool. We'll listen to about a half an hour of that. And then that's it. I'm going to bail early because we're in the middle of the Council of Investment Advisor meeting. Super cool. So we're going to get back and rebalance the portfolio and deploy some new capital. That's what the adults are doing. Yeah, very cool. Cool, right? So what do you think? Everybody agree with that agenda? All in favor, say aye. I'm too close. I'm too close. Zip, zip. Hey, da, boo, boo. Is that a little better? Huh? What do you think? $1 million? $1 million, huh? Yeah, cool. All right. Coolio. So let's get on with it. Let me put it back. We are using Trader's Way MT4 platform for this. We might look at Tradars. One thing I want to point out, summer school's already started. It's already started. So what are you waiting for? Still an opportunity to join. So we've had the Monday meeting. And then on Tuesday, there's been 2 meetings. And on Wednesday, there's been 2 meetings. So there's been 3 days and 5 meetings already. Hurry up, bro. What are you waiting for? Let's go. Okay, you got to join. If you join today, there's 2 meetings tomorrow. It's actually 2:45 a.m. and 7:45. I thought I updated this. Interesting. And where do we go? Okay. Then you have Friday, Saturday, and Sunday off. And then on Monday, you're going to review in excruciating detail everything you did Tuesday, Wednesday, and Thursday. Oh, my God. Huge impact. But it's very exclusive. You have to pay $150. Okay? Okay, cool. So, like, dude, seriously, there's still time. It would be silly not to join. I just really, yeah, it's silly. Okay? Well, I have offshore accounts, master. And by the way, it's not Trader's Way. That's MetaQuotes. So if you're mad about it, master, yell at MetaQuotes. Trader's Way had nothing to do with that. Nothing. Okay? Nothing. Yeah. All right, so beautiful people, the beautiful people. Let's take a look at an update. Fed watch tool. Well, I didn't give you legal advice, Master. All right, so in 9 minutes, we get a new decision and 99.9% chance nothing's going to happen. Cool. All right, are you guys informed? Yep. Well, a month ago, it was 96.5% nothing was going to happen. So things have changed. Yeah, okay, not radical. All right. So now what? Well, what about the next meeting? July 31st, there was my date of birth. I got to the party and I did the Smurf. Drop. All right. 85% chance they ain't going to cut in July. Jamie Dimon of JP Morgan said he thought July, but I bet you that's changed. So anyways, that ain't going to happen. September. Oh, there's a cut priced in September. Now, this changed, by the way. A few days ago, this was 50-50. Now it's 60. Oh, it's actually 70-30, 70.1. 70-30, there's going to be a cut. Whoa. Whoa. 70% chance a cut in SEP. Cool. And I've been doing, that was my projection for a long time. Then I'm like, no cut in November. And so let's go back. September 50475. 50475. So this whole market agrees. No cut. Only 4% chance of a cut in November. December, the majority at 475 to 4.5. So one more hike. 95% chance of a hike by December. But it looks like one in September. Okay, one in September. So in September, we're at 475. In December, we're at 475. In September, okay, we've dropped from 525 to 50. So there's the September, and there's the December. Okay, so there it is. Oh, thank you, Milos. So McKenna says, hey, who gives it 2 cents? Who gives a darn if they ain't going to do anything? It's all about the summary of economic projections, and everything I just showed you could radically change based on the SEP. And that's what we care about. Is that right, Emerald? October 31st, July 31st, that is my date of birth. I got to the party and I did the Smurf. I get it. I got it. I know it's good. My rhymes are tight. You wish you could. Yeah. Yeah. There you go, Emerald. That was for you. Happy birthday, buddy. In July. Cool. So anyways, yeah, there we go. So everything now has to do with the summary of economic projections and specifically the Fed dot plot, which eventually gets added to Quant Box. Go to the Pro, go to the Q Box. Oh, thank you, Trucker. Actually, I've been practicing for years. I've just, building up confidence, you know what I mean? Because I lack confidence. All right. It will be added to this. So this, my friend, have you ever heard about the dot plots? Have you ever heard about the summary of economic projections? And you're like, this is what like the smarty pants people talk about, but you're like, I don't get it. This is it. I built it for you. You are welcome. And so once we learn about the summary of economic projections, and by the way, if you stick with me, Goose, I'm going to download it in about 4 minutes, and we're going to read it together. But only if you click the thumbs up button. Now, I don't know what you got, but it shows me nobody's clicked the like button, so I don't know what's going on there. Is it really that bad? Oh, 39 likes. So 50% of you haven't had the common respect and courtesy. For you other 35 people that didn't click the thumbs up button, I bet you your mother would be disappointed in your behavior. She didn't raise you to be rude. Come on now. Kick down, come clean. Don't be a holdout machine. Don't embarrass your mother like that. All right, so we are going to get this. And I'm probably going to get banned by YouTube if I play the TV. Where do I want to get that? I guess we have a Tradars calendar. Why don't we use the Tradars calendar? That's good enough. It's not super fast, but it works. Okay, and then while that comes out, we know it's not going to do anything. And by the way, I'm super excited. I have 2 full day meetings, Monday and Tuesday in St. Louis. I'm going to be at the St. Louis Fed. So I had one meeting about a month ago, virtual. And now I have 2 meetings in St. Louis. So I'll be in those boardrooms for 2 days. And then I'm going to pick up some ribs. I found my rib place. I'm going to go to a cigar joint. Yeah, it's all good. Got a nice hotel room. It's all good. Then finish on Tuesday and then fly home. And then I have 2 more meetings in July. And I'll explain in a little bit. About what's going on there. But I'm going there to be smarter than most. That's what I'm trying to do. And then I got a Fed project going on too, which is interesting. All right, we're not spinning. Should be spinning by now. Oh, now we're spinning. Whoa, 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 I'm spinning. And I'm waiting for the SEP. I'm not even paying attention to the result here. And so I'm over here on the Fed website, just so you know where I'm at. okay, no cut, no cut, no cut. And there's the summary. They believe interest rates are going to continue falling. Okay. Yeah, thank you, Sinden. So they're projecting all the way out to 3.1, where the Fed funds rate will be by the end of this year, 4.0. Okay? You see? So I'm trying to get the actual SEP, but they're burying it this time. At least I don't. I'm looking at a couple of different places. And I don't have it here. I don't have it there. Let's move things around. Sorry. Economic research resources. Summary of economic projections. And it's Federal Reserve Gov. I was there, but I didn't see it. So let me go there. I'm almost there. I'm sure I have it in just seconds. I'll show you what I'm doing, just so you know. Oops. I mean, one thing we could read right away is the statement. Economic activity is continued to expand at a solid pace. Job gains have remained strong. That's a nod to NFP. But unemployment and the unemployment rate remained low. Inflation has eased over the past year, but remained elevated. In recent months, there has been a modest further progress towards moving it to 2%. In support of its goals, the committee decided to keep the target range at 5.25. The committee does not expect it will be appropriate to reduce the target range until it has gained further or greater confidence inflation is moving sustainably toward 2%. In addition, the committee will continue reducing its holdings of treasuries and agency debt and agency mortgage-backed securities. This quantitative tightening. Okay, so it doesn't tell us much. And who's excited? Who's excited? Everybody give me a whoop whoop. We got our SEP, baby. I'm about to lose my mind. Up in here, up in here. Hey, Master Wealth Builder, send me an email, wayne@fxbootcamp.com, and give me a review, if you would please, on Apex. It's one of these things like I've heard they're good, and then I look at their website and I'm like, this sucks. Website sucks. So I'm like, do they have any decent tech? Like, do they know what's going on there? Like, is it real? So I don't know. Yeah, please do. Thank you. All right, so this is the summary of economic projections. I'm going to have to move over to a new soda. My voice, I'm running out of voice already. I think it was the jaw rule. All right. Let's move over. So these are the dot plots of various things. And what we're looking at, and I'm trying to zoom in here so you can see some of these. Okay, it's like what has happened. So the committee is asked secretly, so you don't tell anybody what you think. It's a survey. And so you fill out a little form and you're like, where will GDP be? And somebody says, I think it'll be here in 2024. What about 2025? I think it'll be here. 26, I think it'll be here. Long run, what's the long run? I think it'll be here. And then, of course, there's a whole bunch of dots, right? They're all deciding. And therefore, the analysts go in and they're like, what's the top range, the lower range, the standard range, the average, the median, the mode, look, you get into it, right? The median, the central tendency, and the range, right? So they go through all of this. That's what all of this is going on. GDP is going to be fairly steady. Unemployment rate, rises a little bit and kind of stays a little bit high relative before. So what they're saying is, even though we've been at like 3.25 for quite some time, they're saying this 4.0 is kind of the new norm. So the Fed kind of wants to see this get above 4, and then they think it'll kind of like get to 4, rise a little above 4, stay above 4, and stay above 4. They're going to reduce the amount of quantitative tightening, or they'll continue reducing the balance sheet, which is quantitative easing. And I think I read it one way, but I'm not sure. This month it seemed to be like we will just continue quantitative tightening. Because remember, with quantitative tightening, they already sell stuff they own. And that does slow the economy. Does anyone know why? Does anyone know why quantitative tightening slows down the economy? Yeah, well, Milo says, move liquidity from the system. But you got to understand, Milos, like most people don't understand what that means. So how about this? If you buy my house, what do you give up? I'm going to make you a trade. I'll give you my house. What do you give me? Money. Yeah. So when you're like, oh, removes liquidity from the system, people are like, I don't know what you just said. Yeah. Okay. Money is removed from the economy, and therefore the money slows. Okay. Simple enough. All right. Unemployment rate above 4, PCE inflation. Yeah, baby. What's the trend there? Oh, look, in the long run, they hit their target. In fact, 2026 is going to be inflation, or PCE inflation is going to be below 2%. Well, hell's bells, isn't that awesome? Core inflation, okay, down and then a sort of a flatten out. Once again, core hits their target. So the Fed believes they're going to hit their target. In 1,000 days, everything's going to be good, everybody. Everything's good. Everything's good. Inflation has nothing to do with massive levels of debt. It has everything to do with what the Fed's doing, and the Fed's going to fix it. So you're good, everybody. And then you're like, but why do they call it the dot plot? Can anybody guess? Why is it called the dot plot? All right, so let Daddy go to work here. Okay. Let Daddy go to work. So we're going to say a bunch of people here, more people here. So it's really a high average of this people, but we can't really get that specific. But more people think lower than higher, so I'm going to put it here. And this is the news, guys. There's a greater chance of one cut in 24. These guys say 2 cuts, this say 1 cut. Oh, so, yeah, okay, all right. Okay, then what? Let me double check I'm getting this right. Are they, 2024, yeah. So this is for 2024. Because look at this, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 people think 1 or none. 11, right? 1, 2, 3, 4, 5, 6, 7, 8 think 2. 11 think 1 or none. Think of it, 4 people say no cut at all this year. Whoa. So, I don't know, right? So, I'm going to balance that out, and there's 1 cut. Okay, another year goes by. One person says still no cut. What a knucklehead. This person's way out there, huh? One person says no cut. Okay, Mahai says, Wayne, how is the Fed control inflation? If they raise interest rates, mortgage loans go up. Yes. And landlords don't like to lose money. No. They will increase rent. More likely, Mahai, they lose their apartment building. But you're not quite on track. The Fed raises interest rates, mortgage loans go up, but people stop requesting mortgages. Okay, so the vast majority of the group next year is somewhere about 4 1/4. And then it starts to get trickier because we're further and further out, right? So now we're this and up. So I'm going to go take this one for 3.25. And then now it's really, but look at, like, there's this one person out here, huh? And then finally pulls it in. Okay. And, you know, this person and this person are probably the same, and it's probably that person. And the lowest, it seems, out there. How do we look at this? 2.5 is the lowest, but there's a lot above to it, and some are very significant. So I'm going to balance it out, and I'm going to say the Fed is really projecting 3.0 in 27. But to get to 3.0, you really do need inflation. You've got to be pumping out about 1.75 inflation. What do you guys think? First of all, how many people generally agree with the Fed? So 1 cut, then 3 cuts, then 4 cuts, then 1 cut. Okay, so we'll call it that. Let me go back to Mahai's question about real estate and all that kind of stuff. Okay, so if rates are high, mortgages, mortgage rates stay at, let's say 8. So landlords are going to jack up interest rates, right? Well, they got their mortgage 5 years ago. So the average mortgage is probably 4.5. So for commercial real estate, you're fine. Now, if you are an American that owns a house, the average, I think, is 3.5 or something. But we'll say average for an American, they're paying a 4% mortgage. But the thing is, they hold it for 30 years. So it doesn't matter. But what it does have the effect on is nobody buys a house. Therefore, eventually, if you do want to sell your house, you're probably going to, because the high mortgage, that raise your high mortgage payments every month, and therefore you can't afford as much of a house, and therefore if houses are going to sell, they have to come down in price to meet the needs of the buyer, and that's disinflationary. But now you're talking about a landlord, and this is not 30%, I meant 30 years. All right, so now, though, somewhere along the line in 2018, you got a 4% commercial mortgage, and it's good for 5 years, or in 2019, it's good for 5 years. So now you got to re-up. And, okay, so the thing is, now your monthly payments double, right? So because your new mortgage is now 8 for the next 5 years, and you can't afford that. So the question Mahai is saying, well, all right, so you double your rent. You can't double your rent. You can try, but it ain't going to work. So what happens? Well, things can get weird here. If the economy was in recession, we're not. Typically, when something like this happens, you're at the peak of a cycle where you've had a boom cycle and you're jacking up rents, okay? and also the cost of getting a mortgage. So you decided to buy your apartment building here in the cycle because it was fully occupied and rents have been going up. So you pay top-notch money and you pay a pretty high interest rate because it's at the peak of the business cycle. So that means the Fed has probably already raised to the top of interest rates. Then you get here and everything's great. And then it starts falling. You don't really know. Okay, you lost a couple of tenants. That's okay. And then you lost a few more tenants. Now you're losing a lot of tenants. You're like, oh my God, what's happening? Well, the economy is now in a recession. So you're like, oh crap. Yeah, so now what? You cut your rent to try to fill the vacancy. Then, you remember you paid top dollar at a top interest rate. So now you're losing money like crazy. Your cost is high and you're losing tenants. So your revenue is down. Then you need to refi on year 5, which is here. And you go to the bank, you're like, I need another 5-year loan. And they're like, okay, tell us about your rents. Well, my rents are falling and my occupancy is falling. You don't have as many tenants. And therefore, my cash flow is down. And we're in a recession, so prices are down for assets like housing and apartment buildings. And they say, okay, well, we'll renew you. So here's the good news. We'll lower the percentage because the Fed has been cutting interest rates. So now we'll lower the percentage, but we also lower the value. And you're already sitting on a big loan. So we will give you the new percent. Well, it's 2%. Right? Interest rate cheaper, so a huge reduction. Fantastic. But for you to continue, we're going to need $5 million in cash. And of course, in that case, Mahai, they love this, but they don't even have that. And the reason for it is they paid too much for the asset and they bought it too late in the cycle. So they lose all their money. The value of the asset drops because rents are low, occupancy is low, cash flow is low, prices are low, and this person takes a loss on what they still own the bank, and then the bank sells the asset to me at the new lower price, at the new lower interest rate, and now I own it forever. Okay, and of course, over time, I get more occupants. The economy comes back. There's lots of demand for apartments, so my rents go up, my cash flows go up, market prices stabilize and return and go up, and I'm sitting on a ridiculously cheap mortgage, and I paid hardly anything for the thing because this guy lost all his money, and I gained all the value. He lost cash, I gained value. And the bank doesn't care because they just want their percent. And now, because I bought at a better price, I never lose out. Cool. So that's how that works. So what'll likely happen if it was a typical business cycle scenario, which we're not, but what would typically happen, Mahai, is asset prices would fall when the Fed makes things more expensive or cheaper, right? But they're not going to raise interest rates. There's 0% chance of that. All right, so what we're talking about now is we still have this debate. Okay, 11 1 and 8 2. Is that right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 1, 2, 3, 4, 5, 6, 7, 8. Yeah. So now if rates come down significantly, inflation comes down significantly, then it'll move to 2. Caribou says, what happened? Okay, well, I looked before the news, Caribou, and it was 99.9% chance the Fed was not going to cut. And they didn't cut. So anyways, so we're looking at this, and now we got to pay attention. So the next PCE is going to be important, right? The next NFP, like for example, the one in July, early July, I want to see a huge revision down. And that would move a couple of these guys down. Because these guys are saying not even one. Okay? Not even one. So you could lean on this December only, but I would still focus right now when we look at smart money. There was still a 60% chance of a SEP cut. Okay, and now it's time to go visit the... just to make sure, how can you tell if Jay Powell is lying? His lips are moving. We're going to watch a half an hour of this, and then I'm going to bail, okay? I'll put closed captions on for you. What do you think? Smell like a plant? What do you guys think of the new Fed music? I gotta go get a Dr. Pepper Zero. Hang on. I don't know, this sounds like torture to me. I don't think I could meditate to this. This would be crazy distracting. While we're watching this, I'm going to be trading Bitcoin on the other screen. Somebody's missing, huh? That's what life feels without you. Yes, I do. I do a lot of trading outside now. Kanana? I do a lot of trading outside now, so yeah. I have multi-screen laptops.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0%
We just
at the end
looked
of this
at
year
this.
and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May.
They don't
and the
use
core
it, though.
CPI rose 3.4%.
So that guy's Wall Street Journal, that guy's
Inflation data
Bloomberg,
received
that guy's
earlier this year were higher than
CNBC.
expected,
Those are the
though
three
more
people I
recent
care
monthly
about,
readings have
side by
eased
side by
somewhat.
side.
Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is
Bitcoin's
uncertain,
been coming
however,
down
and
the
we
last
remain highly
hour or
attentive
so.
to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range
guess
for
it
the
wimped
federal
out at
funds rate
70. Too
until
bad.
we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than
The
earlier in the year,
2%
however,
inflation
and there
has to do with
been
the
modest further
average
progress
2%
toward
growth
our
rate.
inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond.
There you go.
Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data.
See, I think
and
they're
its
more
implications
interested in
for the
employment
outlook and
right
the balance
now
of
than
risks.
inflation.
The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC.
Good, Steve, right out of the bat.
If you could walk me through
Right out of the gate.
committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in
I told you
inflation,
he's good.
and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight.
They call that a
increase
base
in the
effect,
12-month,
by the way.
In the 12-month, reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting.
Bitcoin's going
things.
back up.
If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rate.
He got him in a corner, didn't he?
If we
Holy
get
smokes.
better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Damn, he got him. That was a great one.
Nick
Wall
Timmer
Street
for
Journal.
Chair
Boom,
Powell,
right
if I
off
look
the
at
bat.
The rate projections,
Cool.
I see.
Next one's gonna be Michael
15
McKee.
of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances
Right on,
of the
NP.
differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all of them as plausible. But I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't.
Yeah, what I've been saying for a while is 1.5 cuts.
And don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because
But September
really
changed from 50-50 to 60-40.
It's going to be the totality of the data.
Right, Kanana?
What's happening in the labor
that's a
market,
big
what's
deal.
happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that, and some people do, some people don't. Most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually
this is
does
a
reflect
great meeting.
the data that we got today, to the extent you can.
This is the best
reflect it
meeting
in
I've
one
seen
day.
in years.
I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market?
There's more
to
than
bring
one
inflation all
reporter
the way
from
down
Bloomberg.
to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation.
Watching silver, by the way.
That's ongoing.
Can it get through 30?
Mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep
Mike's
up,
not with
now
with the radio
6/10
team
over the
anymore.
course of a year or so, very,
So it'd
very
be
gradually.
Bloomberg
So you put all that
television.
together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly
definitely
positive
strengthening.
number, greater than it was before the pandemic.
Well, Aussie's down.
Overall, we're looking at
Euro's
what
down.
was still a very
Pound
strong
is
labor
down.
market, but
CAD
not
is down.
the
Kiwi is
superheated
down.
labor market of 2 years ago, or
Yen
even
is
1 year
down.
ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path?
But they're
of
not.
rate cuts
I'm
this
showing you
And
they're
the big thing
down.
that changed was the inflation forecast. So the inflation forecast
Euro,
moved
Oscar,
up several
Mike.
tenths
Dollar
for the
will
end of the
probably
year.
weaken.
And as I mentioned earlier in the
Oh, that's a 5-minute.
you know,
I wonder.
what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to.
Just
begin to,
remember, just because the yens are
loosen
down
policy.
doesn't mean the yen
So,
is strong.
The sense of that is that rate cuts that might have taken place this year, take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than
my
almost
pleasure,
anybody
Carabin.
expected. And we'll just have to see what
We're in the middle of
what
a
the
long
incoming data flow
CIA meeting, too.
brings, and how that affects the outlook and the balance of risks.
Is anyone interested in the fact that we're building millionaires over at the CIA?
Gina Smilek, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run
you not
interest rate
amazed?
forecast moved up a bit.
You should
I wonder
join
if we
and
should
learn how
read
to
that
do
as
this
a
stuff.
sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term.
The website sucks, but it's
back
good.
to your original question, though, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were, you know, very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately, we think that things like the neutral rate are driven by longer-run, slow-moving forces, and, you know, there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And, you know, my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having, you know, the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, you know, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You know, you can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward
Yeah, I'm watching it,
the
ND.
price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And, you know, in the meantime, we're asking, is our policy stance about right? And we think, yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got
That's
growth
not
that
true.
stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had, above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and we'll see what the rest of this year brings. So
I'm
these
waiting for
dynamics
Michael
can
McKee,
continue
but
as long as
we
they
might have to
continue.
go pretty soon.
Ultimately, the
In
question is
fact,
ultimately,
it's pretty late.
are you down to demand? And
All right, well, I got to go to the CIA
look at
meeting.
today's report. If we see more like that,
So we missed out on Michael McKee. What a great press conference. So you should continue watching. So the CIA's meeting, we are looking at different portfolio balances. We need to rotate some money out of underperforming strategies, and we have to move into, projected better performing strategies. Discuss what that mix and allocation will be. So we're definitely going to rotate out and rebalance the whole thing. And then we have some cash to allocate toward a new investment. And so we're going to discuss it and then vote on it. And then I'm going to go into my actual account and one by one enter the trades that the council voted on. And they watch me put the money to work. Real money. And it's in a corporate pension fund. So real money, we're making real decisions, we're having real discussions, and this is it. And if you're worried about future generations in your family, I'll show you how I can make your future family, the family of your children and grandchildren, I can make them millionaires. I'll show you. We're doing it right now. We did calculations and had the conversations, and it's like, I can change the lineage of your family and your bloodline. That sounds like a heck of an exaggeration and hyperbole to the maximum. Well, we're doing it. We're doing it. And that's that. So it sounds unbelievable, and that's our problem. Our results in the first 6 or 7 months, so it's not very much time. So you could discount it and say, wow, it's not much time. It's all luck. Yeah, maybe it is. Maybe it is all luck. It could be. It really could. But what we're doing is real and unbelievable. Oh, is that right? Yeah. Sorry, Henry. So anyways, we're going to go seriously consider the CIA because I think it's one of the most important projects of my life. And I manage this fund, and you're learning how to do this, to be a true money manager. And I manage it the same way I manage my endowments for charity. Amazing, right? Yeah. So let's go. Let's get on with it. Peace on earth. May the pips be with you. May your profits be above average. Thank you for being here. And hey, CIA people, I'll see you over in the room. Cheers.